Good afternoon. Welcome to Chicago, Future of Finance. I'm Oliver Renick. It's December 29th. It's not quite the new year just yet. It's still the holiday season, but we're here. We're at the floor. As you can see, there's some action. The big news is silver selling off pretty hard. It's become the chosen risk asset, the meme-ified asset of the last couple weeks, maybe longer if you include gold's epic run. We're looking at stocks and crypto, a little changed right now. VIX creeping a bit higher after we went real low last week. We put in all-time highs, don't forget, for the S&P 500, both on a closing basis and as of last week on an intraday futures basis too. So as far as I'm concerned, we're largely in the clear. But again, a risk-off day when the definition of risk shifts from one asset to another. And lately, the chosen tool for taking risk has been precious metals. It's been an incredible run. But I think what's most important here is that the big picture remains very much intact, and volatility around meme-ified assets is just the name of the game these days. When you've got conspiracy theories swirling about why something's doing what it is, people trading through ETFs, options on ETFs, futures, something like silver can easily become the highlight of the story and the main feature of the party. Here's where the risk radar is. As you recall, we did have a shift. Here's what it looked like for a while. Here's what it looks like now. There it is. It was yellow on stocks for a good bit there, but now it's a clear green. So the green light is on after we put in the all-time highs on the intraday basis. That was the big event last week. I think the silver stuff is largely sort of a fun story. What to make of it in terms of how it fits with the epic run in gold, I think is an interesting question because gold's getting dragged down with it again today as well. Gold's really been the only thing that's been pure green on my risk radar for pretty much all year, especially really in the last, call it 8 months. Gold has just worked in so many different environments that it has proven itself really as a tool that you need to have in your tool belt as a diversifier for your portfolio. Silver, a little bit of a different beast because silver, of course, has some other properties to it that make it a little bit more of a traditional risk-on asset. There's the move in gold after we put in the all-time highs. You can see it's a little bit more of a stair-step pace, whereas silver's been explosive, vertical, parabolic, exponential, convex, whatever you want to call it. So now we give some back. Obviously, this is an anomaly move, an extreme move, I think somewhat of a substitute for speculation since crypto's been dead in the water for the better part of the year. We're closing out a year in which gold has been absolutely crushing it. Some call that the crypto nemesis. I think actually they pair greatly together. Case in point, the BTGD ETF by David Jacansky at Quantify Funds. It's had a great 28% year, even though Bitcoin's been struggling with BTC. Going to finish off 2025 down roughly 11%. The fact that gold has been able to make up for it, you see how well those two pair together because they're so different. Silver fits somewhere in the middle given some of the more cyclical properties, and generally we think about silver as something that has a little bit more of an industrial bent to it, which means it can have cyclicality, which means it can have extreme periods of risk on and risk off. So I view this more as a speculative risk asset. And by the way, if you've been watching the show, our guests have been giving a heads up on this for really months. Pete Najarian was trading silver. Brent Kochuba and I were looking at some of the flows around some of the assets that are tied to the precious metals. And then Noel Smith last week said loud and clear, be wary of the potential for a margin change. And guess what? That happened. And here we are with a bit of a pullback. So that's the excitement. That's the story of the day. We got a great show coming up, by the way. Steve Sosnick of Interactive Brokers. You can see the guys right behind me there. The chief strategist is going to be joining me, as well as Jay Hatfield from ICAP and Charles Moon from Prosper Trading. Let's get it going, though, with Mr. Kochuba, who's joining me on the Zoom as we get started after, I don't know, it's not quite the end of the holiday season just yet. Brent, it seems like maybe we're still kind of in the ho-ho Christmas holiday window here, right?
Yeah, we had a good Op-Xmas rally, Oliver. We made new all-time highs. And
Op-Xmas, I see what you did there.
I like that, yeah. I'm trying to coin that phrase.
It's a good one.
Yeah, and we got that nice rally there. I think that rally was looking like it was a little testy there, right? And the reason I bring that up is because I think we've largely left now that window of sort of strength due to that condensed holiday time frame. Now, of course, we have still a quiet week with New Year's Eve coming up and New Year's Day, where a lot of people I don't think want to trade. But I think now that the market, the idea of having a clear buying catalyst now seems to have subsided. And we saw last week, some of the lowest SPX implied vols I've ever seen in my life, bar none. We saw 4% implied vols in the S&P.
Wow.
And I think that was due to two things. Number one, we had the Captain Condor blow up, which was just pushing size onto the market, 90,000 lot on Wednesday. As we all know now, that trade has blown up, and it was the talk of FinTwit. And we went from one kind of ridiculous strategy in the Captain Condor martingale to, as you just mentioned, this silver stuff, which is just it's dragging out the Looney Tunes, I'll have to say. And,
Good eyes on Captain Condor, by the way, Brent, as you were describing to us that strategy. And that was kind of interesting to see the way that there was some commentary that he put out over the weekend on his strategy. And I think a lot of professional options traders kind of looked at that and said, hey, if you're out here just doing a casino roulette strategy, then maybe you shouldn't be managing tons of money. But again, everybody's got their own risk tolerances. But give me kind of your conclusion on that, or what is to be determined from how that played out.
You know, I spent countless hours, and I brought that story to the Wall Street Journal, the one that appeared about him in April of 2025, and I said, you know, my angle on the piece was like, look, this guy's starting to get a lot of attention and somehow getting some money together, and this is going to add in badly. It has to, for a variety of reasons. And those aren't like advanced PhD mathematical reasons, you know, some bizarre reason why. There was 4 or 5 just very obvious, you know, to like a high school level analysis of why this thing would break. And my name, even though I provided the article, got stuffed at the very end and said, here's how great this is, like a puff piece about Captain Condor, and at the end is this little thing that says, like, Brent is this angry old man shaking his finger at the strategy, you know? And it was just obvious back then that it was just a limited amount of time until this thing broke. It's just basic stats. And then not only that, the other problem is once you start getting into size, like a 90,000 lot, 90,000 is as big as you'll ever see in the S&P in terms of single orders. He started to swim with the sharks. And the sharks are the guys that are putting those orders up. It looked like that order, which is normally 100% facilitated by a market-making group, it looks like that 90,000 lot was split between a liquidity provider like a bank and also a market maker here. So that was implying that maybe that size was getting too big for even some of the market makers and firms to want to take down by themselves, which put to question, even if they had enough capital to put up 180,000 lot, would there haven't been a liquidity provider to offer them, you know, some of this value? And the other point of that is when people know you're coming, they know what you have to do, right? You lost, you have to double down the next day, so we know what you're doing. We know when you're going to put the order in, you know roughly where you're going to put the order in. It's a zero DT option, so the risk window is very fixed. All those things line up for me to say, hey, Oliver, you want to come trade 90,000 with me? No problem. I'm like nickel bid for your contracts, right? So he ends up putting up a 90,000 lot that's 30 basis points wide, meaning all it took was about a 30 or 40 basis point move in the market to move. And this is just like the movie, 1987 movie Wall Street, where, Blue Horseshoe loves Anacott Steel or whatever. It's like, we know your position and we're going to work that position against you. And out he goes. And to the point of this post, it sort of doxed him as someone who just didn't really understand the options market all that well. But he
first
implies
time
that he's not
our
giving
series. First time, he says we don't effing give up. We'll regroup and try again. Okay, I love the ambition. Sounds like me going to the ATM in Vegas, unfortunately. First time our series failed in over 3 years since Cboe released details in 2022. I understand that maybe, some of this data you can't back test prior, but it's just number one, you're working with such a small sample size.
Yep.
The other thing too is that, it's just, I don't, as we talked about, when you're going through with this strategy, it is sort of a, destined to fail thing unless you can kind of infinitely size your bankroll up with it. And that's, again, just assuming it's even a pure coin flip, which to your point, in the casino, it's definitely not, obviously. That's the whole way they make the profit on roulette. But in the martingale in the market here, to think that you're got any kind of beyond 50-50 edge with the Condor, selling Condors against major market makers, that's a pretty hard bridge to sell me to.
Yeah, and just like a casino, Oliver, you're aware of this. When you want to double down on your, $400 or $500 million blackjack hand, the pit bosses, I believe they're called, they come out and they say, "We're not interested. Like, this is a little too rich. We're done here."
Sure.
Right? And that's exactly the thing that would happen if he's like, "Hey, we're going to do 180,000." And at first, I was kind of biting my tongue on this, but there's all these stories of, traders that lost their life savings, unfortunately, following this strategy. And meanwhile, this guy's posting cars, pictures of his Lambo or whatever. So I don't, for whatever reason, people just don't want to respect basic math and basic strategy with this stuff. kind of like the AMC and GameStop days. It's sort of like you just want to chase this mythical return as opposed to really respecting kind of the risks, right? And so what's funny about that is this thing blows up. He doesn't really seem to offer any remorse about, dragging other people in these losses and seems to infer they'll be back. More power to him if he can just hopefully not drag people down with him next time. Anyways, moving on to that is the next ridiculousness is this silver stuff where over the weekend everyone was claiming that JP Morgan was going to go belly up because of and I think at least the Western financial market, if not the entire global economy, was going to collapse because of silver shortages.
1875, 60. Like, what do people think the leverage is built up in for silver at this point? Like, I'm having trouble following along with this one. It just seems like to me I could write it off as a list of a lot of different assets that have gone parabolic because they took on, the social media meme power, which is a totally real force that we have to understand how it moves in markets today, but it's a lot more about information and the way it travels than some kind of underlying principles of the commodity, in my opinion.
Yeah, that's 100% right. And there's actually just people are just making stuff up. There's this stuff about 8Ks from JP Morgan on FinTwit, and there's like, where's the 8K? And it doesn't exist. And I don't know anything about the silver commodity market, I'll tell you that, but I do know enough about options, and people are starting to talk about the strike set, like the number of calls for SLV at the 70 strike, for example. And one of the quotes I read is, this will unleash a delta hedging rampage. And I know enough about the options market, and we can see in the positioning that is absolute nonsense. So, when you start to pull on a thread of just some basic stuff like that, you just, again, the problem is that there are people that may be shoving their entire life savings into silver now because they're waiting for, again, silver to go even more parabolic. And there's never a situation here, Oliver, where the system won't protect itself. And it's not conspiracy theory. It's just like, look, if it was possible that JP Morgan was about to go belly up because of silver exposure, I'm willing to bet that the regulators would do something to help JP Morgan out and, level themselves out, right? And so, that would be the sign. If they go, like what they did, we did a little video about this bunker hunt in the 80s, right? They made it illegal to start buying silver. For example, they'll do those kinds of things. That's why short selling is made illegal when the markets are crashing. We were talking about another one. Do you remember the famous Goldman Sachs Kellogg's trade where there was like a fat finger?
I don't know that one. Tell me
2013, some algo went off, and someone bought about 50,000 lots of Kellogg calls, right? Little sleepy stock. And what happened? They busted those trades, right? Obvious error trades. They were busted. So if you happen to trade that's great.
You're trading strawberries.
Yeah, then there's the AQR was trying to sue nickel, the nickel exchange, the LME, over some nickel trades that went bad. They lost, and they had to, or Elliott lost, and had to pay for the LME legal fees, I believe. So, anyways, the point is that the system will survive, right? And I think we need the system to survive. We're all better off for that. But again, it's just this funny thing where we're getting these. Normally, you talk about once a year, but now we're getting these rolling things where it's like, the hype and the FOMO, YOLO, I don't know. What other acronym you got, Oliver? You could throw that on the fire. For these chasey trades.
Hopefully not FML for people on the wrong side of the trade. It's to some extent, Brent, I am a believer, actually, of this kind of theory. Others have put it out there before. Crypto was kind of the first one because, let me just preface it by saying I do think there is somewhat of a structural risk for a big portion of the market if crypto collapses the way I think it's possible it could, but that's a totally separate story. I think more important and more relevant the way to think about crypto, meme stocks, and a lot of the stuff over the last 5 years is that they've been able to silo off heavily speculative appetite into places where blowups can happen in a controlled environment, almost controlled demolition to keep the broader market and the index level market intact. So that's kind of the way I've chosen to view this, and obviously there's going to be people who get hurt when they surf on waves that they can't handle. But generally, I kind of think that putting some of these things off into these little wild west corners and letting them sort of flare up and flare down has been somewhat constructive to the broad market. That's kind of been my view on crypto, meme stocks, and a lot of these things.
Yeah, these assets I don't think are enough to shake the global financial system, either in terms of the ETF being traded or Bitcoin, to your point. I think there are moments in time where you get enough leverage in these things where you can see the S&P, for example, or some of the broader indices moved on an intraday basis based on some of this leverage kind of expanding or contracting. I remember very vividly, for example, there was a moment in GameStop when Melvin Capital got their margin call intraday, and the whole market had a reaction to that. It was a very brief reaction. It didn't cause a 20% drop in the market thing, but it was this moment where, hey, there's some funds unwinding, right? Because someone has to sell S&P or buy S&P futures maybe to offset another part of their book, or whatever it may be. So I think you could see these things. And not only that, in this situation, it's interesting because MicroStrategy, to your point, of Bitcoin and Coinbase and a couple of these other names, you get to be 2-3% of the S&P and maybe a bigger chunk of the NASDAQ related to these things. So if you had MicroStrategy hit a big downdraft, you could see a short-term blip, intraday blip in the S&P because of that. But I also think that Bitcoin, just generally speaking, as a proxy for risk appetite, has historically been sort of a leading. In other words, if you see Bitcoin ripping 20% tomorrow, is probably good for risk assets as a general thought process. So,
but the good news is this year Bitcoin's been getting slammed and markets have been jamming, baby. Hey Brent, give me a thought overall on S&Ps and vol for this again a holiday interrupted week. I got Steve Sosnick standing by on IB. So give us a little transition into the stock talk for us.
Yeah, 6,900 is the level to watch. So if we lose 6,900, 6,890 is specifically our risk off level. That's where things I think could start getting a little bit spicy to the downside. If you look at vols for kind of out past next week, so you get past the holidays, there's a bunch of that rolling economic data that comes up, and forward implied vols are a little bit more elevated than at the money vol, right? Or live vol. So what I mean by that is simply is that there's a reason to think that vols are being tethered higher right now. So this idea of we're going to contract vol to help support the equity market or help to push the equity market higher, that Vanna kind of component is not such a lift anymore. The JP Morgan collar strike is still up there at 7,000. I think that's probably out of the picture for now, unlikely to happen. But all in all, if we lose 6,900, below there is where that negative gamma could start to pick up. And then I think we get, pretty quickly down to 6,800s, particularly because of the fact that vol right now really doesn't have anywhere to go to start to lift. So I think that's a little more of a phenomenon into, to start the new year. Generally in this quiet market, I wouldn't expect much, but that's really the level that we're watching. On the single stock side, there's a lot of single stocks that we're starting to get bid up. We're not like at extreme kind of way over our skis levels yet, but there was a pretty good bid to single stock calls, and call skews were steepening a little bit. So those are a little bit rich, and I think right now it's about what is the next buying catalyst. The OpEx miss thing, I know we're laughing about that, but that holiday period, that vol crush, definitely helped the market to lift up. And so what takes the baton in the short term right now, I don't know that there's a clear catalyst, right? We don't have one. And so we've really switched from neutral to bearish if we lose that 6,900 level, as opposed to looking for a nice bullish window, which we clearly had last week.
Understood. Nice. Well said. Thank you very much. Brent, there's SLV, top options volume, and daily gamma notional. I would be a lot more worried about the market if it were Tesla down 8%, but Tesla's only down 2%. Stocks like Micron, which have been very juicy, are making new highs today. So I think overall we can kind of write this off to some extent as a commodity anomaly for the moment. And a little bit of a meme moment. Thank you very much. Brent Kochuba, SpotGamma, always great stuff. Thank you, sir. We got Steve Sosnick on deck joining us from Interactive Brokers. We'll be right back. 2-minute innovator buffer break.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. I'm Oliver Renick. We've got stocks, a little change to the downside, a little bit more for the NASDAQ than the S&P 500 right now. S&P's at 6912 roughly, VIX at an even 1400. I'm very happy to catch up and bring in Mr. Steve Sosnick joining us. He's the chief strategist at Interactive Brokers, one of my earliest sources in the market. And Steve, we got a few of your guys behind me here at Cboe. You can see IB right there, man in the machines. How are you, sir? Want to make sure, I think you might be muted, Steve.
Oh, sorry, I muted while you were talking to Brent.
That's
because I was
right.
like so eager to jump. I was so eager to jump right in. I had to mute myself. Sorry about
good.
that.
No problem. How are you? Good to see you.
Same.
You know, this is a market that's been trading silver like it's going out of business, but the stock market's pretty calm. Give me your overall thought here on how we're closing out the year. We've got some action, but it's in a weird spot. You know, it's like markets in the stock side seem to be fairly calm and fairly still momentum upwards, but we got some weird stuff around the edges.
There's been weird stuff around the edges all year. It's just migrated. You know, when I look at our most active stocks list, it's for most of the year, there would always be, let's say, 2 to 3 or 4 names among our top 25 that I would have to look up a strange 4-letter symbol. And I'd be like, what is this thing? And I'd look at the option activity, and there'd be no options activity, which of course is a tell that it's a penny stock, basically, too small to have options. And we would see these things and they go from, 1 to 12 and then back down to 2 or 3 and then fade away. And so we saw a lot of that risk on type of activity in those things. Those have faded away. But to a certain extent, that's been replaced by precious metal speculation, where there's always some game going on somewhere. There's always some speculation or some vehicle for speculation. It got out of hand with silver. One of my adages that I live by is parabolic moves mean someone's in pain. And somebody was clearly short this thing and wrong. It was not JPM to the point that Brent was making. As he said, if it was them, there would have been something systemic that would have gone on, not just an overnight short squeeze. It isn't. The other thing is parabolic moves unwind in a very messy and unpredictable manner. You know they're going to come to a messy end. You just don't know when exactly. And that's part of the problem. And that's what we saw today. It's also not a surprise that it happened on expiration date. Today was expiry for silver contracts. And that when you have a physical delivered commodity, the normal limits get waived. And so you can see some extraordinarily crazy moves. And I just think that this is one of these situations that has replaced, penny stocks and some other flight to crap type of instruments, at least with precious metals that have historically been stores of value.
Steve, it sounds like you heard some of our conversation there. I think a positive way to view this is that we have, instead of one big bubble in the index, we have these mini bubbles that we can pop. And to your point, parabolic moves mean someone's in pain. Oftentimes also means someone's having a good time. Maybe it does get skewed. I think data tells us it usually skews towards pain for the net outcome. But generally, if we can have that pain limited to these silos, then you've got a market that you look at a lot of valuation metrics. I know it's above average, but it doesn't look that scary. Am I wrong?
I love your idea of siloing off the speculation. I think that's very important. I think as there are times, and I know you and Brent touched upon this, and this is something I've written about extensively, is that lately Bitcoin and precious metals have been proxies for risk before we had small stocks as proxy for risks, et cetera. But I do agree. We've gone through, you know, I guess is sort of like, eating your protein and your vegetables and keeping that part handy, and then, snacking on some real junk food. And as long as the junk food remains kind of a snack, that's not so terrible. I'm not going to
Yeah.
moralize about it.
Yeah, no, I like that point. What is your general thought here on tech and the stuff that's really been driving the market, the core of this? Should we be at all worried, Steve, about the general valuations for the market, the concentration of the market? Give me your kind of top-down view as the chief strategist at IBKR and what you're seeing.
Well, I think I'm like the only cautious guy on the street right now. I actually did put out I never was allowed to do year-end targets just because we don't do recommendations as a firm. And I kind of said, that's not really a recommendation. And compliance agreed. And I came out with 6,500. And
Okay.
literally there was
It's a little bit of a pullback, 500 points.
Yeah, there was an article today saying that, every strategist on the street was bullish. I actually know the reporter. I wrote to her. I said, I'm not. And she said, well, it wasn't that we were going off a different list. But
I know. I used
basically,
to compile that list for Bloomberg, and I guess what? You know
I
what?
do
On
know that.
average, in fact, that's probably one of the early places we started talking. But on average, the strategists on Wall Street usually predict like a 7.5% increase on. So they're basically just kind of like going for the average return. On my chart, by the way, for the S&P, Steve, if you're right and this thing goes down, I mean, I've got a line right there that's at 6,600. So, I mean, support to test. I don't think that would be the end of the world.
well, that's it. I mean, people say, "Oh, you're such a bear." I'm like, am I? If I was really the bear, I would say, 5,000, 5,200. I don't know. We could pick numbers out of thin air. The reason I say this is a few reasons. Number one, be fearful when others are greedy. I am an inherent contrarian. To be fair, the bulk of my career was spent managing the risk of a multi-billion-dollar options market making portfolio.
It's kind of your
And
job
so
to think about the risks and
my job was to figure out
potential.
what could upend this model that worked really well. So to be fair, I've spent a lot of time looking for the monsters under the bed. The things that do bother me are concentration risk. I mean, valuations are high, but valuations don't break a market. That's not. Now there is over the long term an inverse correlation between high PEs and returns. In the short term, on any given year, it's actually about nil. I will say though, we are right about the median length of a secular bull market. So, on that front, 50-50 shot that we
Okay.
go up,
Good
that we keep
context.
going or not. These are low probability. The next few things I'm going to say are very low frequency events. So take them with a grain of salt, but there's a few
Okay.
of them that all converge at once. Number one is the length of the bull market. Number two is second year of a presidential term or midterm election years. We've had 3 down years in the last 10. One of them was barely down. The only 2 that were meaningful down years were 2018 and 2022, where we finished. Obviously, we had a bad 2020, but that recovered quickly, and we had a bad 2025 that recovered quickly. But those 2 periods were down years. 2018 actually is an interesting parallel because we came in not with exceedingly, the VIX was much worse than it was now. I remember having people telling me why VIX was a short at like 11 or something like that. But then we started the year with Volmageddon, and we ended the year with a really nasty fourth quarter. So it's basically that's one of those things that I do have to keep in mind in terms of history. Also, new Fed chairs have an uncanny way of getting tested early in their term. We're getting a new Fed chair. We know that. Powell came into office in February 2018. That was Volmageddon, as we discussed. Yellen had a little bit of a hiccup in 2014, 15, but nothing major. Before her was Bernanke, which was 2006, which was just in time for the global financial crisis. And Alan Greenspan was before him, who came into office August 1987, which was, the crash of 87 was 6 weeks later. So that doesn't mean that any of
I
them
like
are
that
incompetent.
one. actually the most,
Sorry?
Steve. I like that one the most, to be honest. The potential for volatility around a Fed shift, and this is where I know that I also too kind of depart from some of my contributors, and I think a lot of folks that have been right about a lot of things. A lot of people I agree with on basically like the way they trade, the way they think, but then they have this sort of notion about Powell that, you know, he's done a bad job, or like, I mean, look, I've had criticisms of him. I've written about them. I kind of got in trouble for them in a few moments. But overall, I think the proof is in the pudding. We've had record highs in stock market. We have had continued success in the economy. We came through COVID in a way that nobody else did. It catapulted us on top of everybody else. It seems like all the liquidity we dumped in was able to foster this incredible environment for technological innovation. And yet, because he's got this feud politically, we're going to yank the guy out. And it's just, to me, why fix something if it ain't broke? And in my mind, if you're looking at the information, also inflation, which has been subdued now. I know people want it to go lower, but it's not really going up, right? There's been a few pops here and there, but it doesn't look like a broke economy. It certainly does not look like a broke market. And now we're going to take out the main shepherd for that. So in my opinion, I think that resonates with me the most out of all your points of risk.
I'm with you on this one. I think, Powell gets criticism, but, based on what? Yeah, the inflation ran hot around the COVID situation, but he was dealing with something unprecedented. If you're an investor, can you quibble with the returns that have occurred since he's been in office?
And the inflation wasn't specific to us, really.
No, but it wasn't specific. None of it. COVID was not specific to us. The stock market returns. But bottom line is, I do get concerned here, if we want to get specific, that whoever replaces him he's going to get questioned about his independence. And I do think the market is very susceptible to fears of Fed losing its independence. And so my tell has been the 2-10 spread.
I just pulled up the 10-year chart here.
Yeah. But now the 10-year has been relatively contained. So you could see that again, that's another thing that moves, says Powell's doing okay. 4.11 or whatever it is right now, give or take a basis point or two, is a pretty good historical 10-year. We got spoiled during a lot of, the COVID years and around then, because there wasn't any inflation. There is some inflation. We're talking now still about 1% to 2% real interest rates on the long end. That's not tragic. But what I'm looking for here is, that spread has moved. It was about zero for the post-COVID era. It sort of jumped up to the, sort of trading, let's say, 50 to 70-ish in terms of the spread between the 2s and the 10s. We're closer to 70. We were flirting with it recently, but not quite through. If you start to see that spread widen, that's telling you that the market is very concerned about inflation, more so than the run-up in precious metals, which has other factors going on. Bond traders, to me, are relentlessly focused on just one thing. Are they going to get paid back, and are they going to get in real dollar terms? Are they going to get paid back in nominal terms, and are they going to get paid back in real terms? And so if you start to get that concern about them not getting paid back in real terms, that's when I'll start to get a little bit more nervous. I do think that those right now we're sort of okay, but a little bit concerned. And I think that, to me, is the Fed. That's your tell for whether the market is getting nervous about the Fed.
Great stuff. Love that. Sitting right now 4.1, but we were really testing that 4.2. So we'll see if we cross back above that. I do think that if somebody comes in super dovish, then you might get that kind of bizarro bond effect we got when the Fed first started cutting, which is you juice up the economy, yields blow out, and everybody goes, oh, why did that happen? Well, maybe because we juiced it up too much. That's where I'm going to bring in Jay Hatfield. Steve, great to catch up with you, sir. Looking forward to more. Great to see you. Thank you very much, as always.
Thanks so much, Oliver. Talk to you soon. Take care.
Absolutely.
Happy New Year.
Same to you, sir. Steve Sosnick, Chief Strategist at Interactive Brokers. I think it's time we bring in Mr. Jay Hatfield, joining us for Infrastructure Capital Management. ICAP is the ETF. Jay, we're getting right into it here because I got the 10-year chart up right now. Good to see you again. Long time no chat.
Great to be on, Oliver.
Thank you. Tell me first bonds. Tell me what you're thinking here. I know you like to think macro. I know you like to think about some of the things we were just discussing. Anything there that you hate or that you love in that commentary, in particular about the risks possibly surrounding moving Powell out and moving in somebody more politically oriented next year?
We have kind of the opposite concern.
Okay.
Our biggest concern is having somebody like Kevin Warsh come in. Because we strongly disagree with any positive feedback about the Fed. We think they have three fundamental flaws. The most important being they completely made up the 2% target. They blew up the economy by pursuing that target for no reason in the mid-2000s. The target's not properly measured, and they have no ability to forecast inflation. So we're very concerned. We think Warsh would be way worse than Powell. That somewhat supports your point. Powell really doesn't he's not really dovish or hawkish. He just doesn't know what he's doing. He doesn't think the money supply matters. And we're not worried about inflation. There's never been an inflation without excessive money supply growth. You can access that data on our website. Right now, we have negative money supply growth, -6. Oil prices are down 20. So we're bullish because inflation's headed to 2 in our forecast, because we, unlike the Fed, do have accurate forecasts, historically accurate at least. And so we think we're going to have 3 cuts. 10-year gets to 375. That supports a 23 multiple. So we're at 8,000 for next year. So quite a contrast with Stephen's more conservative view.
8,000 S&Ps. You think we're going up by 1,100 points next year?
Absolutely. And I would say, again, not to be too arrogant, but our targets have been extraordinarily accurate. We just use reasonable multiples on reasonable earnings estimates. Our target this year is 7,000, working perfectly. By the way, you're supposed to sell when your stock gets to your target too. So it's working really well as like a ceiling for the market this year.
Okay. And hey, I know that generally that's, I think the last time we talked, you were pretty bullish too, right? So I guess the area then I might push back on, Jay, is that in that entire bullish explanation, which by the way, I think after what we saw the market did this year, I have no reason to think that's going to be off by any means. Why not climb another 1,000 points? I mean, we climbed 2,200 basically off the lows of this year alone. But I didn't even hear anything about tech in your explanation. I mean, it seems like you're coming to this from, I know I kind of queued you up for the macro thought, but that bull case stemming purely from kind of the inflation argument, the crude oil, the macro stuff, that's really interesting to me, because if I were to say, why we're going to 7,000, I would just kind of say nothing matters but tech, basically.
Well, we think that was true this year, but because there's a lot of concern about tariffs and the Fed, and tech in this cycle at least is viewed as being defensive. Next year, we think there are going to be rotation, ongoing, it's already happening, ongoing rotation into the rest of the market. The 492, we do Mag 8 because Broadcom's is a trillion-dollar company. But so we do think that tech will do fine. It's pretty fully valued. We show 7% upside for the Mag 8, which is not very much. But we have a whole bunch of ideas in our funds that have more like 20, 30, 40% upside. So we do think tech will do fine. There'll be a rotation. But most importantly, what I haven't heard discussed is half the economy is in recession. So the housing and construction market is in recession. That's why we have slow job growth. So if the Fed does cut, 10-year continues to go down with the terminal Fed funds rate, that will re-stimulate construction and housing. So we'll have all sectors of the economy hitting. So that'll support this pretty aggressive 23 times earnings multiple for the end of 26, which is based on 27 earnings, obviously.
Okay. Hey, let's check out, let's get into the fund here, Jay. Looking at ICAP. I mean, it sounds like you're seeing a pretty positive outlook for the economy. I see some stuff in here that could click off with that. Citigroup, a bank, Apollo, private equity and investment, Morgan Stanley, another bank, Amazon, of course, one of the big 7 in here. But you got Smokes up top, Philip Morris. You got Mickey D's, which is more of a staple. Chevron Oil. Walk me through the construction of this. Are you going for these names because they've got juicy dividends behind them, or are you going with them because you think they're going to have real capital appreciation in your macro thesis?
Well, both. So we are running a diversified large cap dividend fund. So it's not just an S&P fund. We write individual calls, but it's not an S&P fund that's writing calls. So we're about 10 to 15% tech. So we do have these more standard companies. As I mentioned, I think they're going to do well. Where we do see the biggest upside, though, and we were correct, this year we saw the biggest upside in the big investment banks. So Goldman, Morgan, and all the other GSIBs or money center banks. This year we see more upside in the private equity companies like Apollo, you mentioned, CFG we've been adding to, Citizens Financial Group, because now the cuts will actually be taking place. The net interest margin should improve, and these big investment banks are quite fully valued if you look at their earnings multiples.
Okay. Now, tell me about the option strategy in here. This is one of the hottest areas for innovation in terms of funds, fund creation last year, a lot of it options based. How do you stand out as that competition gets steeper, as folks are really trying to use derivatives more, plug this into the advisor market more? Because there's people that are going to be looking at extremely volatile stocks, using options to generate, heaps of income. Where does this kind of fit in? Why does an advisor use this? How does it fit into the basket of competition for income generating strategies?
So we've been using these techniques for over 12 years. We launched one of the first active ETFs, AMZA. So we've been using covered calls almost longer than anyone. But the way we do it, we use this thing called HI, so human intelligence. Instead of writing index calls, which can cap your upside, if you look at the biggest index call writing fund, it has terrible returns. I won't call out their name, but ICAP has clobbered that fund because what we do is we write individual calls very short term on companies that we have a gain in, so we don't cap our upside, and where we see them pretty close to fully valued. And so we think by curating it that way, you don't cap your upside, and you can see that with the returns. Of course, everybody should verify the returns, but our fund ICAP has substantially beaten all the large cap equity funds and dramatically beaten the equal weight, and is in the same zip code but below the S&P. It's really hard to keep up with the S&P if you're 15% tech versus 40.
Jay, when you pull up the fund on a return basis just for the ETF, 7.5% on the year, there's a part of this we're not seeing on the return, right? Which is what you're getting from the reinvestment of dividends. Tell me what that number is going to look like if you use this fund the way you're intended to, right? Which is to reinvest what's coming back.
Absolutely, and everybody should look up the returns themselves. But I'm looking at my Bloomberg screen, and it says we're up 16.8. So that's an important distinction. We don't want to just give you income, but we want to give you total return. So we've given you 7, 8, 9% of income and 7% of capital appreciation. So that's what you should really look for. You don't want to lose money by having your NAV go down. So that's our target. And that's why the total return is significantly higher than just the price return.
Okay. In terms of back to some of the thematics here real quick, Jay, this is one route to employ these views. You've got a few other funds as well. You've got a small cap version, right? You've got an energy and MLP sector outlook that I thought was kind of interesting. You mentioned also the oil move. I want to get your quick thought on that real quick, just because this has been, I think, a bit of an overlooked story. What's the way to play either oil or the income around the energy companies that overlap with your field of view?
What we do, the good news is that AMZA is our pipeline fund. Pipelines have not done well this year, even though they have good growth prospects from natural gas transportation. But oil is always an indicator people use. They probably shouldn't. We do think oil's bottoming. We don't think OPEC is going to increase production like they have this year. So we think that we'll trade from 60 to 70 so that we're finding a bottom here. So we do think in this rotation into non-tech stocks, MLPs will participate, small caps will participate, which have not until the Fed. Small caps have done well since the Fed turned dovish. So we think that's going to continue into next year. And oil will come off the lows, not go to infinity, which is good because you don't want that from an inflationary perspective. But we'll trade gradually up as OPEC stops cranking up production.
Okay. Well, we're not too far off from the sweet spot. I've been watching the great show with Billy Bob Thornton, Landman, lately, and according to that show, mid-70s is the sweet spot for everybody. We're a little bit of ways away from that right now, but I like the idea of maybe finding a bottom here and maybe how oil can kind of fit into some of the rotation themes. Always an interesting take, a unique take as always. Thank you very much, Jay. Great to catch up. Thanks for being on Chicago Future Finance.
Thanks, Oliver. Happy New Year.
You got it. Likewise, Jay Hatfield, CIO at ICAP ETF. We're going to come back to talk some tech, revisit the silver story, close things out with my guy Charles Moon of Prosper Trading Academy. Don't miss it as we head into the bell here, 14 minutes. S&P 500, only 22 points off. Silver, though, not catching much of a bid, a small one. We are a little bit off the lows, but it's still a big red candle on that one as we head into the bell here. Charlie Moon up next.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. All right, welcome back to the show. I got Mr. Charles Moon joining me from Prosper Trading Academy to take us into the bell. Charlie, right now, silver is just kind of drifting into the finish. I don't know about fireworks necessarily for the close, but we sure got them today. Tell me what you think about this story.
Well, a lot of it is attributed to the new margin requirements around precious metals, right? So, I don't know what kind of effect that's going to have, but it certainly had an effect today. Going forward, is this going to be a dip to rip? This is where I get a little cautious because the chart told me there was a blow off the top candlestick. Usually we see reversals. We saw it in gold twice in the last 2.5 months where they gapped down the following day quite a bit. And a lot of the times when volatility starts kicking in at peak value, volatility sustains, which is never going to be good for upside trajectory. This is where, traders that are going to try to get into this play are going to have to navigate, be pretty swift, be in and out. And I think once it settles, we could see the trajectory of precious metals continue higher because, you know, this isn't a one-off. They've been trending all year long. Every time we think that there's going to be a pause or a reversal, they've broken out and extended on their ranges. So, you know, there's a difference between being top heavy and having continuation versus actually seeing the top and seeing a reversal. So I'm not here to say this is a reversal. I'm just here to caution people on expectations of jumping right back into that breakout mode they've been in over the last 2 weeks.
Sure, understood. Heard loud and clear. The margins, to your point, increasing obviously makes it more expensive to trade. But also, I think when you're looking at that gold chart, to your point, there's a big philosophical question I think we have to ask ourselves right now, which is how similar are these two things? Because if it's like gold, then to your point, boy, do those dips get bought. And they have just been probably the most reliable dips to buy compared to anything over, I think, this year. Fair to say. I mean, gold up 66% on the year. S&P 500 is going to end up over 16% to 17%. Bitcoin down on the year. Nothing has been as resilient as gold. And if you take the chart back, it stretches really well for 3 years with the same story. So if you think silver's cut from the same cloth, bad resource analogy there, then you would want to kind of buy dips. But I don't know if silver's the same. I think it's a little different. I think it's got a little bit more pizzazz to it.
Yeah, this is kind of where the depth of the retail demand comes in now because, all weekend everybody's talking about the short squeeze that's coming in SLV, and I didn't really understand that. I'm not really into commodities. I'm into momentum, but I will look at commodities when there is momentum.
Right.
And all in all, a lot of people are talking about buy up as much physical, which will influence the price of the contracts. And I just, this is where too many hands in the pot on social media comes into play.
People are going to start hoarding silver, trying to squeeze the silver market.
Yeah, no, and like they're calling this, I don't know if you ever heard of the term of MOASS, MOASS, which is mother of all short squeezes.
Right, it was like the bomb
for AMC. Well, it was a war cry for AMC traders, and look at how that turned out. So I do believe that silver has the ability of continuing. I don't believe it will be as dynamic as gold. I do believe that silver is a little late to the party, which is why it's getting a little bit more frothier. I do believe that if gold continues higher, that will just naturally kind of, gravitate towards silver traders that are looking for a little bit better value, that trade at a cheaper price point from a optionality standpoint, from a underlying ETF standpoint. But respectfully, I still believe gold is king. Gold is where you're going to be looking if you're going to be looking at the precious metals market. And that's going to be the determining factor if silver is going to continue or not, in my opinion.
Thinking about how to trade the move in gold, I mean, it seems like with volatility moving higher a bit here, maybe not a bad idea to maybe sell some downside, maybe collect some income, a little premium if gold's, we don't get a lot of 4.5% sell-offs in gold. I see the IV has popped a little bit here over the next couple days into the weeklies and quarterlies. So I don't know. What do you think about maybe selling a spread to the downside or something? What do you think in terms of putting on something that makes sense for one of these? I default more to gold just because I feel a little bit safer in there.
Yeah, and it totally makes sense. And again, that's really where the prominent, money, in my opinion, has been funneled to. There's again a lot of rumors that it was J.P. Morgan that got margin called on silver, which is why it's down the way it is. And I call hogwash on that. Yeah. People are pointing to the overnight repo markets in this situation. I just think this is more of a one-off. I actually like the idea with the implied vol of selling premium, but in a bullish stance. I like the idea that gold's going to recover. They're holding technical support near term. Now, if they fail at these levels, then it might actually be best to look for a little bit of a leverage play to the downside. And there's those inverse ETFs that you could point at to jump into, where those option markets are actually fairly healthy. But my Twitter handle's the disciple of trend. I'm never contrarian. I like to swim with the currents versus against it. I'm going to keep buying the dip because that's where my high percentage plays are,
Okay.
and I will play the downside if they show me significant and sustainable weakness. But in these situations where it could be a one-off and the rebound is more likely to be the play, then I'm going to be looking to play the upside near term. But again, I'm only going to keep it near term because once we start seeing this volatility, it looked like gold was breaking out from this recent volatility where
That's right.
when they went back and forth for the last 2 months. Once you start seeing volatility spark up at these highs, we just kind of get that nonsensical back and forth trading, and it's all about timing and just being appropriate with the timing, and that's it.
It seems like on my chart, 398, $400 between 395 and 400 has been a good spot for gold. It consolidated there. I'm looking at GLD, by the way. Consolidated there before breaking out, gap up. Today's gap down, closes that gap, returns to support. It looks like an opportunity to buy the dip, like textbook basically. If you're just going through the charts, or sell a spread that starts with a strike basically right here. That's kind of how I feel on gold. Maybe it takes a few days or a week or so maybe keep that in mind. But it just, look, if silver goes south in a hurry, I think gold will get dragged. But I think you give yourself some time, and the long-term chart for gold looks beautiful, to your point. Let's hit a few before we close it out here. You mentioned to me you were watching Reddit, Micron, and ANF, Abercrombie and Fitch. Let's go with Micron first because that, I think, looks like a beautiful trend. I think it was Pete last week, Nigerian, who's trading Micron. You and I were talking about it too. I mean, a gift that just keeps on giving, basically.
Yeah, and again, we talked about this last week where I believe this is going to be the standout sector, the memory sector, that's going to be the big play in AI for 2026. The demand out of Asia continues to be extreme, and regardless of the market conditions, I mean, we're talking about Micron being up 3% while the Nasdaq was really breaking down. They're still down 0.5%. So it's also getting more notable that Micron standing out from its peers like Western Digital, like Seagate, like SanDisk as well. So it may be that the other names falter a little bit, but Micron is head and shoulders the name to watch out of this segment.
Totally with you. Nice call on that. You put that on our radar as well. Micron looking good. What's up with ANF, Abercrombie and Fitch? What I missed here, is Sydney Sweeney doing ads for them too?
That's funny. It's almost as if like they got that little boost from
because she did it for American Eagle, right? Yeah.
Right. And it's really funny because last year they were trading around $30 and they exploded to almost $200 a share. They've kind of worked their way back here, dropped down into the $60 range. There was a lot of controversy. I believe their CEO was either arrested or being investigated for I don't know about child trafficking, but it was something very like nefarious. And the stock was down. And then on their last earnings report, it was positive enough where they exploded. They're up almost like 30% for the day off of earnings. And that upward momentum hasn't stopped. They've gone from $75 to $130 in about a month and a half. And it's now starting to, it's almost as if who cares about, A&F and being a clothing company. They're trading like a tech name that is tied to AI. And I just love the momentum. They have a gap fill here near $160 that it just seems like Wall Street is going straight after. They've had like 2 pullback days in the last month, quite honestly.
Crazy move.
Yeah, they've just been an outstanding performer. I don't see it slowing down anytime soon.
All right, I was just pulling up the news flow, and earlier this month, Goldman put them at a $120 target, and we just blew past that in the last week. Good eyes on momentum, the disciple of trend, living up to the name. Charlie Moon, thank you very much. Appreciate it as always. Prosper Trading Academy. Great stuff. Nice call on Micron, putting that on our radar as well. Thank you very much. And thank you for joining Chicago Future of Finance. That's it. Have a great night. I'll see you tomorrow afternoon. Don't miss it, 2 p.m. Central Time.